So very good morning, dear management professionals. So let us continue with the further topics on entrepreneurship development. So today we're going to talk about the financing, what are the various financing options which is available for a enterprise. So we all know that financial planning is very important. So with respect to an organization. So one of the first products with respect to loans is called a term loan. Term loan is also, it can be a short term, it can be a long term. And the prepayment for the loans is based on EMIs. It's where the interest and the principal component are actually divided by the term of the repayment, and then every month equated and the EMIs are being paid. So typically you can see EMIs in personal loans, housing loans, consumer durable loans, and education loans. Here the rate of interest can be fixed or it can be floating. The floating is basically based on the market rates. The interest rates go up and down, but in a fixed rate, the rates are fixed. And the repayment typically is from 1 year to maximum 5 years. And the purpose of a term loan varies depending on the business. Some want to go for expansion, for purchase of assets like equipment, machinery, and raw materials, and to ensure proper cash flow and to meet the working capital requirements, and then for buying office land or space, and then paying off regularly capital operation expenses like rent, salaries, and hiring new staff, and debt consolidation, etc. And these are some of the criteria for term loan. It should be minimum 18 years and maximum should be 45 years at the time, 65 years at the time of maturity. And the applicant should have good repayment history. So you could have heard about the concept called CIBIL, which is called Credit Information Bureau India Limited, where a customer's repayment history is completely there. So in case if there is a default or good repayment, everything is there in the history, basis which there is a score assigned to each and every individual. And any score above 700, maximum score is 800, is actually very good, makes him eligible for apply for a loan. And the interest rates vary from bank to bank, and also depending on the riskiness of the applicant profile, and also for the requirements of the business. So if there is a good credit score card, then there is a good chance of the customer getting negotiating for a lower rate of interest. And term loans offered by banks are comparatively lower and compared to other financial institutions. And see the some of the documents required. So you need to have a proper business plan, and you should have the KYCs like Aadhaar, voters ID card, and for an address proof, for a identity proof, and you have to have a business establishment proof like your registration certificate. And you should have these following documents like last 2 months, 12 months bank statement, and then your turnover as per the norms fixed by the bank. And next we're going to see what do you mean by capital structure. Capital structure is nothing but any flow of funds in terms of any loans taken will be a combination of debt and equity. For any financing, this combination is always there, debt plus equity. The equity is nothing but you are actually subscribing to the shares of the capital, and the person who's buying the share becomes the owner of the owner in the particular organization to the extent of the number of shares he's purchased, and is eligible for cash flow as well as profits. Now debt is something which is in terms of bonds or loans, it is called debt. Now this ratio of debt to equity is very, very important for critical for the business. Then there are ratios which actually suggest what is the level of debt and equity, which are not going to cover today. And these are some of the next we're going to see what is meant by export finance. Now all export is a very, very important area of business area, where a lot of foreign exchange gets earned, and exports are very, very critical for any economy. China is a very, very big country where they export a lot when compared to imports. And export typically needs a lot of support, and finance is one of the very crucial among them. And the finance covers into 3 areas. One is the pre-shipment area, the post-shipment area, and also finance against collection of invoices and letter of credit. So let us quickly see what is each one of them. Now pre-shipment. Now pre-shipment is when see before an exporter exports any goods or services, any goods. See, definitely he needs a lot of capital for purchasing the raw materials as well as processing and then converting in finished goods, packaging, etc., and transport. Now there is a credit called packing credit, where you can avail these from the your particular financial institution, where you can show the export order and receipt from where you can actually show your export order received from an importer, and you can avail this packing credit. Now, once you can, once this packing credit, how it is recorded is, now once the importer pays you back the money, the financier will adjust your packing credit amount against the importer's payment. And next is actually the bill discounting and invoice factoring. Now, bill discounting already, as we said, suppose you are an exporter and you are importing to a particular country, and then you will have an invoice raised against the importer. Now, that particular invoice can be discounted, and a financier can pay you not the full value of the invoice at a discounted rate. You can get, but the money comes in faster. That is called business discounting. That is also an example of a post shipment finance. And next is also called invoice factoring. Now, invoice factoring is similar when compared to bill discounting. But invoice factoring is actually much faster when compared to invoice discounting. So a letter of credit discounting. Letter of credit is very simple. Your bank gives a guarantee on behalf that actually you can, they will pay you in case of a default. Suppose there are two parties and a bank will is giving a letter of credit for party one. Now, in case of a default by party one, bank will stand as a guarantee to party two. So that is also one terms of post shipment finance, which is called letter of credit discounting. And the next option in terms of for export finance is called angel financing. Now, angel financing. Now, angels are actually called high net worth individuals. So they are also called business angels. So angel financing, they do a lot of financing for especially entrepreneurs. Now, angel financing do the financing where they are typically high risk, high reward players, and where they expect the rate of returns will be very high when compared to traditional investment opportunities. So when how this angel financing for entrepreneurs works is, typically as an investor, typically as an entrepreneur, you're going to pitch your idea to the angels, and if it attracts the attention, as well as if they are investors, the angel is convinced, then he's going to invest in your startup. So angel investors are actually not like passive investors, they're very active investors. They're going to play a very active role in the business, and they help you also in terms of financing for subsequent rounds. And angel financing, when compared to debt financing, is far less risky, because you need not pay the capital as an entrepreneur. You need not pay back the capital invested, but angel investors are going to play a very active role in your organization. And also the management control also will get influence in terms of angel investors. And the next type of financing is venture capital. Venture capitaling is actually more organized. It is actually a investment vehicle for wealthy individuals and entrepreneurs, where the institutions are investors. And wealthy investors are it's a group of people who like to invest the capital in a startup which is having a long-term growth perspective. And venture capitalists are financing basically by, as usual, equity participation, and also through capital gains, and also sometimes they extend conditional loans. Now, the most recent funding option is called crowdfunding. Crowdfunding is nothing but a very informal way of accessing a vast networks of people through social media, the funds. So where the pool of investors actually contribute to a particular business venture. And crowdfunding does not have any intermediary, so you can raise directly from the individuals. And crowdfunding is actually a very simple way and a very user-friendly way to raise funds. And crowdfunding will definitely take some time, but end of the day, the rate of interest and the crowdfunding is definitely less when compared to term loans. So thank you very much. If you got any questions, thank you.